Everyone, welcome to the Rocky Mountain Investment Challenge video. Going to try to give everybody a background on how you might create a presentation for the Rocky Mountain Investment Challenge. I'm going over one that won several years ago. You do not have to use this format, but for those who don't have a good idea where to start, this is a good place. You can also go to drfranksfinanceworld.com and see videos on fundamental analysis, and that will give you some really good background information on where to find data that we use in these presentations. So, anywho, most of the time when you start these presentations, you start with the end. This is actually the last slide most of the teams do, where they say what the price is now, what is a target price, why you might want to buy it. You do not have to have a buy recommendation. You could have a sell or a hold if you wanted. The sort of litmus test for that typically is if you're going to make maybe 0 to 5%, 6, 8%, you would be a hold, maybe up to 10%. At that point, you'd probably be a buy. If you could make more than 15 or 20%, probably a strong buy. Anything you think you'd lose money is either going to be a hold or a sell. But at any rate, for Visa, they had industry-leading margins. The way you find margins is you look at the income statement as a percent of sales. So they had kept more of every dollar than the other competitors did. Obviously, Visa's the biggest dog in the market out there. Some growth prospects that were pretty cool, and a valuation that was fairly low. They think it's undervalued by about 17%. Just as a reminder for the Rocky Mountain Investment Challenge, they are teams of 3 to 5. We tend to prefer value stocks. I think they're easier to analyze, to be honest with you. If you want to do something else, that's okay, but you're going to get into different multiples and things like that for a future evaluation a year from now. The way you screen for those is you look for low price to earnings and low price to book companies out there. Maybe they pay some type of dividends is another way to look at those kind of firms. FinViz is a great place to go, finviz.com, or just hit this link and go to the screen page, which is on the very front. The tab has a screen tab, and you can go in there and see what I mean. There's some discussion of that in the fundamental analysis videos too. Anyway, so you will have a 10-minute presentation with a 10-minute Q&A. Fundamental analysis videos background, like I said, is at drfranksfinanceworld.com. So, this is the next page the team had. Obviously, they didn't have that last slide in there, but just give some general background information. You can get most of this off of Yahoo Finance as well. The ticker symbol, where they're domiciled, so you can look at taxes and so forth, current price, 1-year target, yours. You can also give what the analysts think. Intrinsic value is just another thing you can find through your own analysis or others. Anyway, number of shares, how big they are, market cap wise and so forth, whether they have debt, and if they have a dividend yield or not. This is probably the more important part of it, where the team was actually giving an estimate on revenue of $20.22 billion, where the market was only giving it at 17.73. Pretty aggressive, honestly, for the team to have done that, but all you have to do, you can put whatever number down you want as long as you can kind of defend it. They thought that while they would make more money, they would keep more, but not infinitely more. Obviously, they thought their expense ratios were going to be a little higher inside of there, and then they came out with so much per share. These numbers were a little closer. If you had just backed this out one more year, these numbers were almost dead on. You can look at the analyst coverage inside of Yahoo Finance as well and see how many are buy or hold or sells on that. So they ran a couple of charts. Graphs are kind of fun and cool to talk about how they did relative to others. The S&P, these are exchange traded funds you can go look up and compare them to. The XLF is a iShares, I believe it's a finance exchange traded fund, and then the K is technology. Some people would say Visa is a finance company. Other people would say it is a technology company. As you can see from the charts, Visa has definitely done better. They did this inside of Bloomberg, but there's many chart programs out there that you can do this, including a simple one out of Yahoo Finance. So they did a couple of these. This is where I thought it got more interesting, because they were looking at the compound annual growth rate. You can actually calculate this using a time value money calculator. I'm going to be putting a time value money calculator tutorial on the Dr. Frank's Finance World soon. But basically, if you put in the current revenue as the present value and the future revenue as the future value, and of course one negative, the other positive. You hit the number of years you're going over here, and then calculate I. You would actually get that compound annual growth rate. It's kind of neat when you put these basic charts together, or these PowerPoint slides together. Put as much information as you can without it being cluttered. They were talking about growth rate and revenue, so they actually put what the revenue was for Visa, MasterCard, American Express, some of the other competitors. Once again, in the fundamental valuation, you can find competitors on Morningstar. There's sometimes just by going out, obviously MasterCard is one of them, so would be Discover and so forth. But at any rate, you can find their data as well. This is maybe one of the most important parts, because first things first, you want to say, where is this company up until recently getting its revenue from? And they put it into a pie chart, which is an easy way to visualize it. And service revenue, which is earned from services provided by client usage, the largest contributor to earnings, what it was, percent of operating revenue, and so forth. And then the data processing revenue, what that was, and what percentage that was. They also put compound annual growth rate, because if these are the two biggest segments of Visa, then you'll want to see, how are they growing? And while this one is the biggest one, it's actually only growing at about an 8% rate, which is not bad, but the data processing is growing at 1.5% or more higher than that, and it won't be too long before the data processing revenue would actually be the largest segment at current growth rates. They also have international transaction revenues and other revenue out there. And so this information you can typically get if there's broken up segment data on Morningstar or some of that. You can also get it from the 10K and 10Q filings from the company's website or from Edgar and get that information. But same kind of thing, you're looking at international revenue up 10.5, which is higher even still than the other two. And other revenue, which is licensing fees and things like that, is growing at a much slower pace. That's not as big a deal for them. Anyway, the interesting thing about this one that's different than others you'll see is the growth rate. The highest growth rate of all is actually in client incentives. And I think if you were to look at that these days, it would be things like getting your 2% cash back on cards. Essentially, they're sharing revenue, and everybody has to do that now so that the people who provide credit cards to people can share that, and it doesn't come out of their pocket. So anyway, these kickbacks, if you will, were in client incentives were becoming a bigger part of what they were doing, and they definitely want to bring that into the revenue picture because it's about 20% of operating expense. The next, and I highly recommend you do that, many of the value firms that you go with geographic location, many of the value firms will have multiple locations around the world. And this helps you see, the world doesn't grow at the same rates out there. And you can see, for instance, that they acquired Visa Europe, which was not a big revenue thing for them. You can see it's the little blue one down here. But they did a lot on Visa in the United States. They also did a lot in Latin America, and a big market for them they were hoping out in the future was going to be China, because China had just lifted some of their barriers to entry over there. So once again, why is your Visa? They had better margins. They kept more of every dollar than the competitors, stronger national growth, and undervalued relative to the market. So they then started to say, okay, what do they mean by industry-leading margins? You can go with operating profit margin. You're working your way down the income statement. You have gross profit, and then operating profit, and then net profit margin. And as you can see, there's some other competitors they got off of Bloomberg here, but you can get others too. And you can see the operating profit margin for MasterCard was not as good. They did not make as much money, and they didn't make as money as in net income. A 46% net income margin is amazing. They're keeping 46 cents of every dollar. The average S&P company is about 7 or 8 right now, maybe 9. Anyway, they gave price to earnings ratio as another one that you'll look at a lot out there. You can see it's very similar between MasterCard and Visa. The market is willing to pay 29 times approximately next year's earnings out there. And so you can see where other competitors are. PayPal is higher and so forth. You can get into return on equity. Visa wasn't as high, but they weren't quite as leveraged up as MasterCard. Return on equity includes debt and stuff like that too. as opposed to return on assets. But at any rate, you can see even MasterCard was doing a little better return on assets as well. But obviously from this picture, Visa was the big dog compared to the others. Just look at the visualization and how they're trying to tell the transaction history, billions, 126 billion transactions a year using Visa, for instance. Strong industry growth prospects. You were looking at, they were in the United States and Canada. They were also in Latin America. That's becoming a much faster growing region of the country as well. They were in Europe. They had 2% of them coming from Africa, which is becoming a bigger market, growth market for people. And they also had the Asia Pacific market out there. And they gave some basic numbers on the United States international and stuff, broke it down to tell the story about their international revenues and growth and where it's coming from. Next, they got into how they actually did the metric of valuation. They were looking at, a price to earnings multiple was one method they were going to value it. And they said if they used a price to earnings average, you can see the average between PayPal, Visa, and MasterCard over here came out to be about 28 times. And they looked at 28 times next year's earnings. That was the earnings they were forecasting. 28 times 3.79 gives you a $109 price based on a price to earnings model. They also did price to book, which is pretty common. When you came over to price to book, you can see that while Visa sold it quite a bit less, MasterCard was quite a bit more, PayPal and so forth. Might be a little generous on the 7.2 times book value relative to others out there, what's been in the past, but still came up with a $101 price. They also did a free cash flow model out there, also known as discounted cash flow to equity. We went over this in the fundamental valuation as well. Most student managed funds and a lot of analysts use this out there as well. What you do is you take earnings from the future and multiply it by that future PE to get a future price. You also take the cash flows you make along the way and per share, and you bring all those back at whatever your cost of equity is. This is simply a CAPM. If you've had any finance classes at all, the capital asset pricing model says you take the risk-free rate, expected market returns. The difference between that, this is many times known as a market risk premium. That's what they had down here. Multiply it by beta and add back your risk-free, and they had a cost of equity of 8.57. So each of these multiples they were going to bring back, the future value of the price earnings multiple plus the cash flows, they were going to bring it back at 1.0857 based on the number of years you're bringing back. There's a full coverage of this in the fundamental analysis out there. It's something you'll probably want to do, but you can watch the video many times and I think figure out. It's what we do at our student managed fund at Colorado State. So catalysts are kind of interesting as well. These are what you think are going to help the company do better in the future. You would probably want to put some type of macroeconomics, see what you think the economy is going to do over the next year or so. And you can see they got it from Fred, which is the Federal Reserve, usually out of St. Louis. You can get the data, and it talks about different things, talking about personal consumption expenditures, PCE, and so forth, or the unemployment rate falling or the PCE rising. So people are going to spend more. I thought this was a very unique slant that they put on here that probably helped them quite a bit, which is the transactions. You can see where it used to be 50% was the 51 about for cash. It's 47, and this is in 2015. I would bet money, little thing there since we're talking about money. I would bet money that less than 20% of transactions over 25% are cash now, and the debit cards and stuff has just ballooned and ballooned and ballooned, which will be a moneymaker for MasterCard and Visa and so forth. Then they also talked about acquisitions, Visa Europe, Costco. If you want to put these kind of cool things in here, you can go to Visa Europe or to Costco and you can just copy their little emblems and put them in. But it does make for a nice presentation. Union Pay, which was apparently an Asian, probably Chinese company that they signed it with, as well as with the U.S. government to do healthcare and savings accounts and government spending and that kind of stuff. So all that was going to be a net positive for Visa. The negative, of course, is the dependence on certain clients. This comes in more often than you'd think, actually, in the investment world. You shouldn't just look at their revenue. You should look at the revenue based on who they have as clients, because if 30, 40, 50% of the revenue comes from one group and they lose that group, guess what? They're only making half as much money. So they were talking about the portion from certain clients. Technology advancement could always be a problem. Is there going to be some type of, a token or coins, or Walmart was looking at having their own uh, money, if you will, out there, cyber money or whatever, crypto and so forth. They have to worry about security as well. And then, of course, just geopolitically, what's happening around the world. I know, for instance, when the war started in Europe, they pulled all of their assets out of those countries that were part of the war. So this, as they get to the end, is just to show you did the one calculation to come up with $109 when you're using the price to earnings model. But one of the things you can do is keep the earnings the same, as you can see over here, and change the multiple that people might actually pay for it. They subtracted one and added one, you get different prices. Or keep the multiple the same, but change the earnings per share and see what that will lead to different prices for them. It's just a way of seeing how sensitive the model is to certain assumptions you've made along the way. They did the same thing down here with basically cost of equity and terminal PE and so forth for the DCF model, and they talked about what that would lead to price-wise, upside potential and so forth. That was their final call, and they conclude their presentation. Now, interestingly, and I would recommend you probably put this in here, the judges don't probably have enough time to go look through all this, although if it's really close between a couple of schools, they will go. I know I've been a judge at CFA competitions at least, and they'll see how you did your work. There was the income statement you came up with and the balance sheet you came up with, and what were the assumptions and how you did your DCF and how you did your multiples, price to earnings and price to book, any cash flow, margins and ratios and that type of stuff. And I'll just run through it so you can actually see it because you won't get to see it otherwise. But that's the revenues that they had, that they were coming up with, the numbers to projections and so forth. That was the balance sheets that they were working with as well, and different notes associated with that. They then looked at their DCF one-year target. If you go look at the drfranksfinanceworld.com, the video on there that talks about DCF uses a very, very similar method here to sort of look at what's going on with some of this type of stuff. But at any rate, this was their assumptions for operating. One of the things they did I thought was interesting, a lot of and this is something I always keep in mind, we talk about fundamental analysis, a lot of them that the income statement balance sheet that they pulled, it was getting newer to older this way, while what they predicted was getting newer to older this way, which can be a little bit confusing. It's just something you need to watch for out there and when they're predicting where they're going to be. Anyway, that's just a breakdown of what they did on the DCF model. A little more breakdown of that. Then they did a multiples valuation, and they're talking about the price to earnings, price to book, price to sales, EV to EBITDA and so forth out there. And they're comparing MasterCard with Visa and so forth, and PayPal, and why they came up with the numbers that they did, just to show that basically they had done their homework. They also did a cash flow analysis, or at least looked at it up to that point in time and see whether they had any issues. It looks like they were becoming sort of cash rich, which is good. They could pay down their debt or whatever after the '08 debacle. You can see how important that would be. And here we are with their EBITDA margin. People don't just look at operating margin, which is EBIT divided by sales or revenue. They also take EBITDA because depreciation you don't write check for. And so it's just another way of looking at cash flow. And they were looking at what their estimates were for that going forward. Finally, it's good to look at ratios out there where their valuation is now versus price to revenue, price to cash flow, price to book, and so forth. Anyway, you can just look at, especially their financial strength, and you're looking at quick ratio and current ratio, see if they have money, whether they can pay their debt, they can cover their interest 19.8 times, so they're in pretty good shape there. And anyway, a lot of people will have pension plans. Sometimes they're legacy plans that have a hangover that are actually important as well. So you can look that up. They wouldn't look what the pension plan looked like for them and whether they were going to have trouble with that in the future. They did not look like they were. And then finally, a debt analysis. It became important. You can see this Visa had to pick up some debt right here. And, when that would come due determines when they're going to have to go back to the market. This one isn't until 2045. But for companies, especially now that we've seen interest rates rise in 2022, for companies that have to do loans in 23 and 24, maybe even all the way out to 25, it's going to be more expensive for them. And so, big debt things, multi-billion dollar, $4 billion worth of debt out here is going to be something they're going to have to watch for coming up in the future. Anyway, they did a little more about the bonds and the ratings on the bonds and so forth. They did one more about target sensitivity, just put that information down. And then they looked at management themselves. Here's the guy that runs it. Because you want to know if you think that they're going to do a good job or if they've got a lot of experience at it and so forth. So anyway, this is how I would start a Rocky Mountain Investment Challenge. This is where you kind of need to try to get to be competitive. We have the largest pot this year ever in the history of the competition for students. So take your best shot at it. Let us know if you have any questions, and we appreciate you guys being involved. Have a great day. We'll see you. Bye-bye.